All right, deep divers, so glad you're joining us today.
Great to be diving in again.
You know how much we love really unraveling something complex, pulling out those aha moments that just make everything click.
Absolutely. That's the goal.
Well, today we're definitely on a mission. We want to decode one of the most critical yet often unseen processes in the financial world. How auditors identify, assess, and then actually respond to risks of material misstatement in financial statements.
It sounds technical, but it's fundamental.
It really is. Think of this as your behind-the-scenes look, your shortcut to understanding how those financial watchdogs think, how they ensure the numbers you see are, well, reliable.
And this isn't just for accounting buffs, right?
No, not at all.
If you're an investor, maybe a business leader, or honestly just someone who relies on financial info to make decisions, understanding this is key.
Absolutely fundamental, as you said.
It's more than just checking numbers. It's really proactive detective work. Auditors are constantly searching for what could go wrong, hopefully long before it becomes a real problem.
It's the foundation, isn't it?
It really is. It's the bedrock of trust in financial reporting, and it's, well, surprisingly intricate once you start pulling back the layers.
Okay, let's unpack this detective story then. First step. We need to really grasp what we mean by a risk of material misstatement. It sounds like a bit of a mouthful, doesn't it?
It does, but the concept itself is crucial.
So when we talk about a material misstatement, we're not just discussing like a simple typo in a footnote or a minor rounding error.
No, definitely not. We're talking about a mistake or maybe an omission in a company's financial statements that is so significant, so impactful,
enough in that.
that it could actually change your economic decisions if you knew about it. That's the threshold.
Right. So if knowing about it would change whether you invest or maybe whether a bank lends money.
Or even if a supplier extends credit, exactly. If it crosses that line, then it's material.
Can you give an example? Something to make it really concrete.
Sure. Think back to, say, the dot-com bubble burst. You had situations where seemingly small misstatements, or maybe really aggressive ways of recognizing revenue,
Yeah, I remember that.
could literally wipe out billions in market value overnight for companies that, frankly, had no real sustainable business model. That's the power of materiality. It's the line between a negligible error and potentially a financial catastrophe affecting real people.
Wow. Okay. So that distinction is crucial then.
It is because it defines the auditor's fundamental role. Their job isn't to find every single tiny error. That would be impossible, right?
Impractical.
It's to provide reasonable assurance, that's the key phrase, that the financial statements are free from precisely these kinds of material misstatements, whether they're caused by an honest mistake or, unfortunately, sometimes by deliberate fraud.
Okay. So to start that deep dive, that fundamental assessment, what's in the auditor's core toolkit? What do they need to understand about a company before they can even begin pinpointing where these risks might hide?
It's a pretty comprehensive approach. They need to develop a deep understanding of really four key areas.
4 areas. Okay.
First, the entity itself, the company they're auditing. Who are they? What do they do? How are they structured? The basics, but in depth.
Makes sense. Get to know the patient.
Exactly. Second, they look at its environment. This includes the industry it operates in. Is it growing, shrinking, highly competitive? Also, the regulatory landscape, the general economic conditions, things like that. Context matters.
Okay. Entity and environment. What's third?
Third, they need to grasp the applicable financial reporting framework. These are basically the rule books.
Like GAAP or IFRS.
Precisely. Generally accepted accounting principles, GAAP, in the U.S., or International Financial Reporting Standards, IFRS, used widely elsewhere. Are they using the right rule book? Are they applying it correctly?
And the fourth area?
And fourth, they delve into the entity's system of internal control. These are all the safeguards, the processes, the checks and balances that company has put in place internally to ensure accuracy and prevent errors or fraud.
So things like approvals, reconciliations.
Yes, exactly. Segregation of duties, IT access controls, oversight functions. It's the company's own defense system.
And putting all 4 together.
This comprehensive understanding isn't just, background reading. It helps them pinpoint exactly where risks might be lurking, both broadly across the whole company and in specific, detailed accounts or transactions.
So it's like mapping the terrain first.
That's a great analogy. Mapping the terrain before you go searching for hidden treasure, or in this case, hidden trouble.
That makes a lot of sense. You've laid out that framework really clearly. But when auditors actually start looking for those risks using that map, Where do their eyes go first? Is it a broad overview, or do they immediately zoom into the nitty-gritty details?
It's a bit of both, but they generally start broad and then narrow the focus. Think of
Mm.
it like looking at the entire forest first and then zooming in on individual trees, maybe even specific leaves on those trees. There are really two key levels where these risks tend to show up. Hashtag 1.2.1 financial statement level risks, the big picture risks.
Okay, so level one, the forest view.
Right. These are called financial statement level risks. Think of them as issues with the health of the entire forest problems that relate pervasively to the financial statements as a whole.
Pervasively, meaning they could affect lots of different parts.
Exactly. They're foundational issues that could ripple across many different accounts, many different disclosures, impacting numerous individual assertions, which we'll define properly in a moment.
Okay.
And these big picture risks are particularly relevant when an auditor is considering the risk of material misstatement due to fraud.
Why specifically fraud?
Because if there's a problem at this high systemic level, like a really poor control environment or management overriding controls, it often suggests a broader, more fundamental vulnerability, or even a breakdown in the overall integrity of the financial reporting process itself. It can cast a shadow over everything.
Okay, so if we're talking problems with the entire forest, what are some real-world examples? What kind of foundational weaknesses trigger these big red flags?
There are several common ones, and they really highlight critical areas where things can go fundamentally wrong. One big one is a weakness in the process used to prepare the financial statements.
How they actually put the numbers together.
Exactly. Imagine if the company's recipe for, cooking up their financial reports is just fundamentally flawed. Maybe it's how they develop significant accounting estimates. Those often involve a lot of judgment.
Yeah, things like estimating bad debts or asset lives.
Precisely. Or maybe it's how they prepare complex disclosures. If the method itself is unreliable, it affects everything that comes out of it. It's like trying to bake a cake with a broken oven. Your ingredients might be fine, but the result, compromised.
Okay, so the process itself. What else?
Another major issue is weakness in the overall system of internal control. This is like a company operating with no clear policies or no effective oversight, maybe processes that are just consistently ignored or bypassed.
Kind of chaotic.
Yeah, it creates an environment where errors or even fraud can just easily slit through the cracks across the board. Intentions might be good, but without proper controls, it's almost a free-for-all.
I can see how that would be pervasive.
Definitely. Then there's the lack of qualified personnel in financial reporting roles. This is a big one. If you put someone untrained or inexperienced in a critical accounting position, maybe someone who doesn't understand a complex new accounting standard,
The risk of errors just shoots up.
it skyrockets. It's like putting a novice pilot in charge of a jumbo jet. You're just asking for trouble.
Makes sense. Anything else at this level?
One more key area is a poor selection and application of significant accounting policies. This is like, choosing the wrong rule book for your specific business, or maybe misinterpreting the rules in a way that leads to a fundamental misrepresentation of the company's financial health.
Like recognizing revenue too early.
That's a classic example. If you decide to book revenue before you've actually delivered the product or service, that's a policy issue, and it can impact everything from profits to assets. It's a financial statement level risk. Hashtag taxed 1.2.2 assertion level risks, the detailed transaction risks.
Okay, so that covers the big picture, the forest. Now let's zoom in on those individual trees or maybe even the leaves. What are assertion level risks?
Right. So contrasting that forest level view, assertion level risks are those that relate to specific things, specific transactions, specific account balances, or specific disclosures.
So not the whole report, but maybe just say the cash balance.
Exactly. Or the revenue from one particular product line, or maybe a specific footnote disclosure about a lawsuit. Instead of affecting the entire financial statement pervasively, they're targeted. They're the individual trees or maybe even the leaves on those trees, as you said.
And here's where it gets really interesting. You mentioned assertions earlier. You said we define them. What exactly are these assertions that auditors are scrutinizing at this really granular level?
Great question, because this is fundamental to how auditors break down the audit. Think of assertions as management's claims, either explicit or implicit, about the numbers and disclosures in the financial statements.
Claims. Like what?
Okay, so when a company presents its balance sheet and lists, say, $1 million in cash, They're implicitly making several claims about that number.
Such as?
Well, first, they're asserting that the cash actually exists. It's real, it's in a bank account somewhere. That's the existence assertion.
Okay, exist.
Make sense? They're also asserting that the amount, the $1 million, is correctly valued. That's the valuation assertion.
Hmm.
It's not overstated or understated due to errors or foreign currency issues.
Existence, valuation, what else?
When they report sales revenue, they're asserting that all the sales transactions that actually occurred during the period have been recorded. None are missing. That's the completeness assertion.
Completeness. But
And they're also asserting that those recorded sales truly occurred during that specific period. They didn't say, book next year's sales early. That's the occurrence assertion.
wow, okay, so there are quite a few.
There are several key ones: existence, occurrence, completeness, valuation, allocation, rights and obligations, presentation, cutoff. Auditors break down the financial statements into these specific claims because it gives them a very structured, methodical framework to test everything.
So they're essentially saying, management claims X about this account, let's test X. They claim Y, let's test Y.
Precisely. Let's test each of those claims one by one for this specific account or transaction type. It makes the whole process manageable and ensures comprehensive coverage.
Okay, so once these specific detailed risks are identified for each assertion, like, say, the risk that inventory might not exist or that maybe not all sales were recorded, completeness, how does an auditor actually assess how severe that specific risk is?
Right, so for each assertion level risk they identify, auditors assess two key components. They look at inherent risk and control risk.
Inherent risk and control risk. Let's break those down. What's inherent risk?
Okay, inherent risk. Think of this as the raw underlying susceptibility of an assertion to a misstatement before you even consider any related internal controls the company might have.
Before controls.
Yeah.
So just the riskiness of the thing itself.
Exactly. It's the raw risk. Imagine a company starts selling a brand new, really complex financial derivative product. That transaction type inherently has a high risk of being misstated simply because it's new, complicated, may be hard to value, regardless of how good the company's controls might be.
Okay, that makes sense. Like assessing a patient's underlying condition before considering medication.
That's a perfect analogy. You need to understand the underlying vulnerability first. So, what factors influence inherent risk? Well, we consider the likelihood of a misstatement occurring and also the potential magnitude of that misstatement if it did occur.
Likelihood and magnitude, how
Yeah.
big and how likely.
Right. We also look at specific inherent risk factors, things like the complexity of the transactions. Obviously, dealing with complex international mergers is inherently riskier than simple retail cash sales.
Sure.
Also, the level of subjectivity involved in certain accounting estimates. Estimating the useful life of a unique piece of machinery or the value of goodwill from an acquisition. Highly subjective, high inherent risk.
Right, lots of judgment calls there.
Exactly. And even those overarching financial statement level risk we just talked about, like a weak control environment, can elevate the inherent risk for many specific assertions.
Okay, so auditors sort of gauge this. Is it like a yes-no thing? High risk or low risk?
No, it's more of a spectrum. Auditors use their professional judgment to determine where on the spectrum of inherent risk a particular risk falls. It could be low, high, or somewhere in between. It's a continuum, like, a scale from counting pennies in a jar, probably low inherent risk, to valuing a completely novel type of cryptocurrency, potentially very high inherent risk.
Got it. So that's inherent risk. What about the second component, control risk?
Okay, control risk. This is the risk that a misstatement that could occur in an assertion, a misstatement that gets past the inherent risk hurdle, will not be prevented or detected and corrected on a timely basis by the entity's internal controls.
So this is about whether the company's own safeguards actually work.
Precisely. If a company has a great internal control system, clear policies, regular reconciliations, strong segregation of duties, its control risk for certain assertions might be assessed as low.
Because the controls are likely to catch problems.
Right. But if their controls are weak, maybe poorly designed, or consistently bypassed, perhaps due to understaffing or lack of training, then control risk would be assessed as high.
Because errors are likely to slip through.
Exactly. And this assessment relies heavily on the auditor's understanding of the controls that are supposedly in place, and critically, on their plans to actually test the effectiveness of those controls later on. You can have the best-looking controls on paper, but if they aren't actually operating effectively, they're useless for reducing risk.
Okay, so we have inherent risk, control risk.
Yeah.
After all this meticulous assessment, you said not all risks are created equal. Some get flagged as significant risks and land on a high priority list. What pushes a risk over that line? What makes it significant in an auditor's eyes?
Significant risks are essentially the ones that keep auditors up at night. They're the really big red flags. Technically, they are identified risks of material misstatement where the inherent risk assessment, remember, that's the risk before considering controls, is judged to be close to the upper end of the spectrum of inherent risk.
So high inherent risk is the key driver.
It is. It's a critical judgment call for the auditor, but these are the areas where they'll concentrate their most intensive efforts, because these are inherently the areas most prone to serious error or, importantly, fraud.
Okay, and here's something you mentioned earlier that seems really important, a passkey moment.
Yes, absolutely crucial. The determination of whether a risk is significant must ignore the effects of controls. It's based entirely, solely, on the inherent risk.
Wow. So even if a company seems to have amazing controls for, say, revenue recognition.
Right. Even if they have seemingly brilliant controls, if the underlying revenue recognition process is inherently complex, involves huge subjective judgments, or is known to be prone to fraud in that industry, it can still be designated as a significant risk.
Why that separation? Why ignore controls at this stage?
The logic is you identify the risk in its raw, uncontrolled state first, get a clear picture of the inherent vulnerability. Then you figure out how to respond with your audit procedures, taking into account whatever controls might exist. It forces a more rigorous, almost a more pessimistic starting point, which leads to a more robust audit approach for these critical areas.
That makes a lot of sense. Identify the danger before relying on the shield.
So what are some common real-world indicators? What characteristics make an auditor say, okay, this isn't just any risk, this is a significant one?
There are several common threads, and they really highlight where financial reporting gets tricky and, frankly, more vulnerable.
First and foremost, the risk of fraud. If there's any indication, or even just a heightened susceptibility to potential fraud in an area, it's almost automatically considered a significant risk. Auditors are specifically trained to look for fraud risk factors.
Okay, fraud is always significant. Makes sense.
Next, significant emerging economic, accounting, or other developments. Think about a company suddenly having to deal with a major new, highly complex accounting standard like the new lease accounting rules a few years back.
Oh yeah, that caused headaches.
Exactly. Or if they operate in a rapidly changing economic environment with new regulations popping up. The inherent uncertainty and complexity dramatically increase the risk of misstatement. That often flags it as significant.
What about related parties? I hear that term a lot.
Definitely. Related parties and significant or unusual related party transactions are often major indicators. These are transactions between the company and parties closely connected to it, like its executives, major shareholders, maybe family members of key management.
Why is that risky?
Because the transactions might not be at arm's length. Imagine a company selling goods to its CEO's private side business at, say, huge discounts, or with unusually long payment terms not offered to regular customers.
Raises questions about fairness, valuation.
Precisely. Objectivity, proper valuation, potential conflicts of interest. All significant risks.
What else?
Improper revenue recognition is a classic significant risk area, especially in industries with multiple hard-to-value parts to a sale. Think about software companies selling a license, plus maintenance, plus consulting, all bundled together.
Yeah, how do you split the revenue?
Exactly. Or long-term construction projects where figuring out when and how much revenue to recognize each period is really challenging. The subjectivity and complexity make it ripe for misstatement.
Okay, revenue's a big one.
Always. Also, non-routine, unusual, or complex transactions. These are things outside the company's normal day-to-day business.
Like a big merger or acquisition.
Perfect example. Or issuing a complex new type of debt or derivative financial instrument. Or a major corporate restructuring. Because they're infrequent, often unique, and usually have intricate accounting rules, they're inherently prone to error. Significant risk potential.
What about estimates? You mentioned those earlier.
Yes, accounting estimates are other subjective measurements with a high degree of estimation uncertainty. This is a huge area. Could be estimating the value of unique intellectual property or the useful life of very specialized machinery, maybe the amount needed for future warranty claims, or the likelihood of collecting on a large loan portfolio.
Things that depend heavily on judgment and future assumptions.
Exactly. They involve significant judgment, depend on future events that are hard to predict, and can be highly subjective. Fertile ground for potential misstatement, hence often a significant risk.
Any others?
One last common one is when accounting principles themselves are subject to different interpretations. If the official rulebook isn't crystal clear, or if there's legitimate debate among experts about how to apply a standard in a specific situation, there's a higher inherent chance of misstatement, even if it's unintentional. That uncertainty can elevate it to a significant risk. Hashtag 1.4, how auditors size up each specific risk.
Okay, so the auditor has identified all these risks, some flagged as significant. For every single one, what's the next step? How do they size it up? What questions are they asking?
For every single risk identified, significant or not, they have a kind of mental checklist, specific considerations they need to ask.
Okay, first,
What exactly could go wrong at that relevant assertion level? Be specific. So if we're looking at the existence assertion for inventory, what could go wrong is, well, the inventory physically isn't there, even though it's recorded, leading to an overstatement of assets. Define the potential error.
okay, define the what could go wrong. Next,
Assess the significance, the potential magnitude, and the likelihood of that potential material misstatement happening. This ties right back to that spectrum of inherent risk we talked about. How big could the error be? Is it likely to be a few dollars, or could it materially impact earnings? And how likely is it to actually occur?
magnitude and likelihood again. Got it.
Then, a really crucial question, especially with modern IT systems, are substantive tests alone insufficient to get enough good audit evidence? If so, that means tests of controls will be required.
When would substantive tests alone be insufficient?
Often when a company uses a lot of automated IT processing where manual steps are minimal, or maybe where there's simply no physical documentation trail for transactions, think online sales or automated billing, you might have to test the system controls because there's nothing else to look at.
Right, no paper trail.
Exactly. And finally, they need to determine whether the risk relates only to a specific assertion for one account, or if it might have a more pervasive effect on the financial statements as a whole. Is it just one leaky faucet, or is the whole plumbing system potentially compromised? This helps gauge the breadth of its potential impact.
Now, you mentioned earlier that for public companies, there's another layer of oversight, the PCAOB, the Public Company Accounting Oversight Board. What specific guidance do they add at this risk identification and assessment stage? Does it change things significantly for auditors of public companies?
It definitely adds emphasis and some specific requirements, all focused heavily on investor protection, which is the PCAOB's mandate. Their standards reinforce and expand on these core principles. For instance, they explicitly require auditors of public companies to identify significant accounts and disclosures and their relevant assertions based only on inherent risk, completely ignoring the effect of controls at this initial stage.
Reinforcing that point about inherent risk being primary.
Absolutely. It forces auditors to confront the raw risk first, ensuring they don't get complacent just because controls look good on the surface. The PCAOB also mandates that auditors evaluate both qualitative and quantitative risk factors.
So not just the dollar amount.
Right. It's also about the nature of the account or transaction. Is it complex, subjective, prone to fraud, susceptible to management bias? Those qualitative factors can make even a smaller dollar amount significant.
What about companies with lots of locations or subsidiaries? How does the PCAOB handle that?
Good question. The PCAOB dictates that significant accounts and disclosures are identified based on the consolidated financial statements. You have to look at the big picture for the entire group, not just isolated parts.
Why is that important?
Because a risk that might seem small at one subsidiary could, when combined with similar risks at other locations, become material to the company as a whole. You need that consolidated view. And importantly, these significant accounts and disclosures, along with the relevant assertions, have to be consistent for both the audit of the company's internal control over financial reporting, which is required for most public companies, and the audit of the financial statements themselves.
So the two audits are tightly linked.
Intricately intertwined, because a company's controls are what underpin the reliability of its financial statements. They have to be looked at together.
And for those multi-location audits, does the PCAOB say how much work needs to be done at each place?
Yes, they provide pretty detailed guidance there. The core principle is that the amount of audit attention devoted to a particular location or business unit should directly correlate with the assessed risk at that location.
So focus the effort where the risk is highest.
Exactly. You don't just audit every location equally. That wouldn't be efficient or effective. You prioritize based on risk. Factors they consider include the nature and amount of assets, liabilities, and transactions at that location. Are they handling huge amounts of cash or just minor office expenses?
Makes sense.
Also, the materiality of the location itself relative to the whole company. Specific risks tied to that location. Maybe it's a foreign subsidiary operating in a country known for high fraud risk.
Right.
They also look at whether risks identified at one location could also apply to others and potentially aggregate to a material amount overall. Then there's the degree of centralization. Are records kept locally or managed centrally? How effective is the control environment specifically at that location? And how well does the company itself monitor activities there? It's a very nuanced, risk-based allocation of audit effort.
Wow, okay. After all this intense identification and assessment, drilling down from the big picture to specific assertions, considering multi-location nuances, applying PCAOB rules, what's left? You mentioned documentation earlier. Why is documenting this whole process so absolutely critical? It sounds like it could generate mountains of paperwork.
It can generate a substantial amount of documentation, you're right, but it is absolutely fundamentally critical. It's not just bureaucracy, it's the bedrock of audit quality and accountability.
Why is it so important?
Think of it as the auditor's detailed record, their evidence trail. It serves multiple purposes. It helps the audit team plan and perform the audit effectively. It allows supervisors to review the work properly. And, crucially, it demonstrates that the audit was conducted in accordance with professional standards.
So it's proof of due diligence.
Exactly. If something goes wrong down the line, maybe there's a major restatement, a lawsuit, or a regulatory investigation, this documentation is the auditor's primary defense. It's their evidence showing they identified the risks, assessed them appropriately, and designed procedures to address them. It proves they acted diligently and professionally. Without it, they'd have a hard time defending their work.
Okay, so what specifically must they document related to this risk assessment phase?
The standards are quite specific. They must document.
First.
The audit team's discussion about the susceptibility of the financial statements to material misstatement and how they applied the financial reporting framework. This isn't just a note saying, we talked. It needs to cover how and when the discussion occurred, who participated, like the partner, manager, key staff, the specific subject matter discussed, maybe potential for revenue overstatement in a new product line, and the significant decisions reached about the audit plan and procedures needed.
So a record of their collective brainstorming and strategy.
Precisely. Second, key elements of their understanding. Their understanding of the entity, its environment, its internal controls, like documenting how the sales process works from order to cash. They also need to document the sources of information used to get that understanding, like interviews, reviews of manuals, prior year work papers, and the specific risk assessment procedures they perform, like analytical reviews, inquiries.
Okay, understanding documented. What else?
Third, their evaluation of the design of the controls they identified as relevant and their determination of whether those controls have actually been implemented. This shows they verified the controls exist and are in place, not just assuming based on a manual.
Design and implementation checked. And finally,
they must document all the identified and assessed risks of material misstatement at both the financial statement level and the assertion level. This includes specifically identifying which ones they deemed significant risks and any risks for which substantive procedures alone wouldn't be sufficient, like those heavy IT environments. And crucially, the rationale for their significant judgments made during this assessment. Why did they assess inherent risk as high here, but medium there? That reasoning needs to be clear in the documentation.
so the more complex the company or the environment.
The more extensive the audit procedures naturally need to be, and in turn, that should always result in more extensive audit documentation. It's a direct correlation. It's the complete paper trail, or often digital trail these days, of their diligence, making every step transparent, justifiable, and defensible. It's really a testament to the rigor needed to build that trust in financial information we talked about.
Okay, so the risks are identified. They're assessed, categorized, meticulously documented. We know the potential pitfalls, the danger zones on the map. Now what? This is where the strategy shifts, right? How do auditors actually respond to these assessed risks? Let's start broad again. How do they respond at that overall financial statement level, kind of setting the tone for the whole audit?
Exactly. This is where the audit strategy really takes shape, moving from detection and assessment to decisive action. The overarching goal now is to reduce the overall audit risk. That's the risk of the auditor issuing the wrong opinion, like saying the financials are fine when they actually contain a material misstatement down to an acceptably low level.
Okay, reduce audit risk. How do they do that broadly?
It involves several powerful overarching strategies, almost like setting the mindset and allocating the right resources for the entire engagement.
Like what?
First, they might emphasize or communicate an increased need for professional skepticism among the entire audit team.
Skepticism, meaning be more questioning, don't just accept things.
Precisely. Encouraging a more questioning mindset, challenging management's assumptions, digging deeper into evidence, corroborating explanations, and never just taking things at face value, especially in those higher risk areas identified. It's about maintaining objective distance.
Okay, heightened skepticism. What else?
They might assign staff with more experience or specialized skills to the higher risk areas. If the client is in a complex industry, like say biotech R&D, or has highly technical accounting for things like derivatives or pensions.
You want your A-team on that.
Exactly. You assign your most seasoned pros, maybe even industry or technical specialists, to those challenging parts of the audit. You wouldn't send a rookie into the most complex, high-risk part of the forest alone.
Makes sense. Match skills to risk.
Right. They also might change the nature, timing, and extent of direction and supervision of the audit team. This means closer oversight by senior members, more frequent check-ins, more detailed reviews of the work papers prepared by junior staff, especially for work done in those risky areas. It's more hands-on management and quality control.
More oversight.
Auditors also often incorporate a greater level of unpredictability into the audit procedures. This is key.
Unpredictability, why?
To prevent management from anticipating the audit steps and potentially, manipulating things or concealing problems just before the auditors look. So they might choose different locations to visit each year for inventory counts, or test different types of transactions, or perform certain procedures at unexpected times, or even introduce procedures not typically performed for that client. It keeps management guessing and makes the audit less routine.
Ah, keeping them on their toes. Clever.
Exactly. And finally, they might make changes to the overall audit strategy itself based on the risk assessment. This could involve, say, amending performance materiality.
Performance materiality. So what's that again?
It's essentially the threshold the auditors use for planning and performing their detailed testing. It's set lower than overall materiality for the financial statements. If risks are assessed as higher, auditors might set performance materiality even lower, meaning they have a smaller tolerance for error in their detailed testing and will need to do more work.
So, tighter scrutiny.
Right. Or they might alter their plans about whether or how much to test the operating effectiveness of controls. Or they might decide to shift more of their substantive procedures, the direct testing of numbers, closer to the period end, rather than doing them earlier at an interim date.
Okay, so adjusting the overall game plan.
Yes. And it's worth noting again, the PCAOB standards specifically state that for public companies, this overall response to financial statement level risk must include an evaluation of the company's selection and application of its significant accounting principles. They have to ensure the company isn't just picking policies that make them look good, but that are actually appropriate and consistently applied, especially in those complex subjective areas that often drive significant risks.
Okay, so that's the overarching plan, setting the stage. But beyond that, how do auditors drill down? How do they respond to those specific granular assertion level risks we talked about earlier, the ones tied to individual transactions or account balances? This is where the really detailed surgical work begins, isn't it?
Absolutely. This is where the auditor gets highly targeted, like a surgeon focusing on a specific area. They design specific audit procedures that directly address the risks identified for each relevant assertion of each significant class of transaction, account balance, and disclosure.
Each relevant assertion. So existence, completeness, valuation, etc.
Exactly. For every significant account, for every claim management is making about it, the assertions, if there's a heightened risk, there needs to be a specific audit procedure designed to address that risk. And the linkage between the assessed risk and the specific procedures performed must be absolutely clear and demonstrable in the audit documentation.
Can you give an example of that linkage?
Sure. Let's say the assessed risk for accounts receivable is high for the valuation assertion, meaning there's a high risk that some customers might not pay, and the allowance for doubtful accounts is understated.
Oh.
The audit procedure design must directly address that risk. So the auditor might decide to increase the extent of procedures, like analyzing the aging of receivables, having detailed discussions with management about the collectability of specific overdue accounts, reviewing subsequent cash receipts after year-end, and maybe even increasing the sample size for confirming balances directly with customers. See the direct link. Risk of non-payment leads to procedures focused on collectability.
Got it. Laser-focused response.
Precisely. And throughout this detailed testing phase, maintaining that professional skepticism we talked about is paramount. Auditors have to ensure their own potential biases don't inadvertently impact how they consider evidence, especially potentially contradictory evidence.
Meaning they can't just look for evidence that confirms what they expect.
Exactly. They have to be actively looking for and open to considering evidence that might suggest something is actually wrong or that their initial risk assessment might need revising. It's a constant, active evaluation, not just going through the motions.
Okay. And you mentioned earlier there's a handy way to remember how auditors vary these detailed procedures, the NET concept. Can you remind us what NET stands for and how it helps them tailor their response?
Yes, NET is incredibly useful. It's a mnemonic for the three key levers auditors can pull to adjust their procedures in response to assessed risk. It stands for nature, extent, and timing.
Feature, extent, timing.
Okay.
Let's take those one by one. What does need to refer to?
Nature refers to what kind of audit procedure the auditor performs. This includes both its purpose, is it a test of control, checking if a rule is followed, or a substantive procedure, directly checking the numbers, and also its specific type.
Types are
Like inspecting documents, observing a process, inquiring of personnel, confirming balances with outside parties like banks or customers, recalculating figures, reperforming a control procedure themselves, or performing analytical procedures, looking at trends and relationships. There's a whole toolkit of procedure types.
And how does risk affect the nature?
The higher the assessed risks of material misstatement, the more persuasive the audit evidence needs to be. So the auditor will vary the nature of the procedures to get that higher level of reliability.
More persuasive,
Yeah,
meaning more reliable evidence.
exactly. For instance, if cash is deemed high risk, just inquiring of management about the balance, less persuasive, isn't enough. They'd likely perform a direct confirmation with the bank, highly persuasive external evidence. Varying the nature is often the primary way to respond to higher risk because it directly impacts the quality and reliability of the evidence obtained.
Okay. And you mentioned something about using the company's IT info.
Yes, critical point. If the auditor plans to use information produced by the entity's own information system as evidence, like a system-generated report, the accuracy and completeness of that information must first be tested. You can't rely on data coming out of a system if you haven't verified the system itself is reliable. Garbage in, garbage out, potentially.
Okay, that's nature. What about extent?
Extent is about how much of a procedure is performed. It refers to the quantity, maybe the number of times they observe a control, or more commonly, the sample size used when testing a population of transactions or account balances.
So how many items they test?
Right. Logically, the higher the assessed risks of material misstatement, the greater the extent of audit procedures should generally be. If accounts receivable is high risk, they might decide to confirm balances for, say, 100 customers instead of just 30.
More digging.
More digging, exactly.
Yeah.
Auditors also consider the tolerable misstatement level, how much error they can accept, and the desired degree of assurance they need. A higher desired assurance usually means a greater extent of testing.
Makes sense. Nature, extent.
Yeah.
And the third lever is timing. What does that involve?
Timing refers to when the audit procedure is performed. Audit tests can be done at an interim date, maybe a month or two before the company's year end, or they can be performed at or near the period end, the company's actual year-end date.
And how does risk influence timing?
Generally, the higher the assessed risks of material misstatement for a particular assertion, the more likely it is that substantive procedures will be performed closer to or at the period end.
Why is that? Why wait until year end for high-risk stuff?
Because performing tests closer to year-end reduces the risk that significant errors or changes could occur between the date the testing was done and the actual balance sheet date that go undetected by the auditor. Imagine testing inventory controls thoroughly in June for a December 31 year-end. If controls are weak or if major issues arise in the second half of the year, the June testing might not reflect the year-end reality.
So testing at year end gives more current evidence for high-risk areas.
Exactly. It provides the most relevant snapshot. Now, performing procedures earlier, at an interim date, can have benefits like identifying major issues sooner, allowing more time for follow-up. But it then requires the auditor to perform additional procedures to cover the remaining period between the interim test date and year-end.
Bridging the gap.
Right. They need evidence for that roll-forward period. In deciding on timing, the auditor also considers practical things like when is the relevant information actually available? Some things, like year-end physical inventory counts, obviously only happen at a specific time. And they also need to consider if electronic data they need might only be retained by the client for a limited time, influencing when they need to access and test it.
Okay, so nature, extent, timing net. Those are the dials the auditor adjusts based on risk.
Precisely. And when they design these procedures using net, they're constantly considering that likelihood and magnitude of potential misstatement, the specific characteristics of the transaction or balance, whether their risk assessment already reflects effective controls, and whether they actually plan to test those controls. All those factors feed into the net decisions. It's a very deliberate balancing act.
So when auditors are planning their net, deciding on the mix of procedures, they essentially choose between two main overall audit approaches, right? Two big strategies for how they'll gather evidence.
That's right. Broadly speaking, it boils down to either a substantive approach only or a combined approach. And the choice often hinges significantly on the auditor's assessment of the company's internal controls.
Okay, let's start with the substantive approach only. What does that mean?
A substantive approach only means the auditor decides not to rely on the company's internal controls to reduce the risk of material misstatement. They might assess control risk at the maximum level, perhaps because the controls are known to be weak, or maybe they're non-existent for a particular area, or maybe it's just not efficient to test them.
So they ignore the controls for testing purposes.
Essentially, yes, for reliance purposes. They still need to understand the controls as part of understanding the entity, but they don't plan to test their operating effectiveness to reduce their other work. As a result, they perform only substantive procedures, those detailed tests of account balances and transactions, and substantive analytical procedures.
So all the assurance comes from directly testing the numbers.
Exactly. They're saying, we can't or won't rely on the company's internal safeguards for this area, so we'll get all our evidence by digging directly into the numbers ourselves, probably with more extensive procedures.
Okay, that's the substantive only route. What's the alternative, the combined approach?
The combined approach, as the name suggests, uses both tests of the operating effectiveness of controls and substantive procedures.
So here they do test controls.
Yes. The auditor plans to rely on the controls to some extent. They test them to confirm they are operating effectively. The key benefit here is potential efficiency.
How so?
Because if the tests show that the controls are operating effectively and can be relied upon, the auditor generally needs less assurance from their subsequent substantive procedures. This means they can potentially reduce the extent, maybe smaller sample sizes, or sometimes alter the nature or timing of their substantive tests for that assertion. It's a more integrated approach, leveraging the client's own good practices to make the audit more efficient.
So good controls can mean less direct testing of the numbers.
That's the principle. But remember, never zero substantive testing for significant areas.
Right. Now, you mentioned earlier that sometimes testing controls isn't just an option, it's actually required. When does that happen? This seems really important, especially now.
It's incredibly important, especially with how much businesses rely on IT today. Tests of controls are generally required, meaning the auditor must perform them. They can't just choose a substantive-only approach in several situations.
Like when?
First, when a significant amount of the entity's information initiating transactions, authorizing them, recording, processing, reporting is done electronically. Think about online retailers processing millions of sales automatically, or automated payroll systems. Substantive procedures alone might be insufficient because there might not be a visible audit trail to follow.
No paper trail again.
Exactly. Second, closely related, if an entity conducts its business primarily using IT and no documentation of transactions is produced or maintained other than what's in the IT system itself, if an electronic invoicing system processes everything without ever creating a printable invoice or storing a PDF image, the only way to get assurance is to test the controls embedded within that IT system that ensure accuracy and completeness.
You have to trust the machine's process.
You have to verify the machine's process by testing its controls. Third, when audit assertions relate to routine business transactions that are subject to highly automated processing with little or no manual intervention, again, if a computer system handles everything from order entry to cash application based on preset rules, testing the system's controls is essential because there's no human reviewing each step to catch potential errors.
Okay. Automation drives the need for control testing.
It really does. And finally, if the audit evidence itself is obtained primarily in electronic form, the sufficiency and appropriateness of that electronic evidence become entirely dependent on the effectiveness of the controls over its accuracy and completeness. If the controls around the electronic data are weak, you can't really trust the data the system spits out, can you?
No, you really can't. Wow. So the reliance on IT basically forces auditors towards testing controls in many modern audits. That's a huge shift from, say, 30 years ago.
A massive shift. The nature of evidence has changed, so the audit approach has had to adapt.
Now, speaking of efficiency, you mentioned dual-purpose tests earlier. They sounded clever. Can you explain those again?
Yeah, they're a neat trick for efficiency. A dual-purpose test is when an auditor performs a test of controls at the same time as a test of details on the very same transaction.
How does that work?
Okay, imagine the auditor is examining a sample of paid invoices. They might check if each invoice has a manager's approval signature on it that's testing the operating effectiveness of the approval control. Simultaneously, for that same invoice, they can verify the vendor name, the amount, and the date against the supporting purchase order and receiving report that's a test of details, gathering substantive evidence about the accuracy and occurrence assertions for expenses.
Ah, so one sample selection, two types of tests done together.
Exactly. It serves two objectives at once. Evaluating if the control worked and gathering direct evidence about the numbers. It's like, well, killing two birds with one stone, audit style, very efficient when feasible. Hashtag tag 2.4, the risk procedure matrix, a crucial passkey.
Okay, this is all starting to form a picture of how risk drives the audit strategy. To really solidify how that control risk assessment influences the choice between substantive and combined approaches. You mentioned there's a vital concept, almost like a passkey matrix. Can you lay that out simply?
Absolutely. This matrix is a great way to visualize the direct relationship between the auditor's assessment of internal controls and the resulting mix of audit procedures. Think of it like this. Scenario 1. The auditor assesses the client's internal control system for a particular assertion as essentially none or weak, maybe poorly designed or just not functioning.
Okay, data controls.
In that case, the assessed control risk is high. The auditor can't rely on the controls. Therefore, will they perform control tests? Generally, no, because there's nothing effective to test, unless, as we said, heavy IT use requires it. And what about substantive procedures? They will perform maximum substantive procedures. All the audit assurance has to come from directly testing the details and balances.
High control risk, maximum substantive testing.
Got it. Scenario 2. The auditor assesses internal control as having some effectiveness. Maybe some controls are okay, others are weak, or they're not consistently applied.
So mediocre controls.
Right. In this case, the assessed control risk might be medium. Will they perform control tests? Yes. They likely will test the controls they think might be effective to see if they can get some level of reliance. And if those tests are successful, they can then perform perhaps minimal or reduced substantive procedures compared to the high-risk scenario. They get some assurance from controls, reducing the need for extensive direct testing.
Medium control risk equals test controls plus maybe less substantive work.
Okay. Scenario 3. The auditor assesses internal control as strong. Well-designed, consistently applied, effective controls are in place for the assertion.
Good controls.
Here, the assessed control risk is low. Will they perform control tests? Yes, definitely. They need to confirm that these seemingly strong controls are actually operating effectively throughout the period. And if the tests confirm the controls are strong, they can generally perform minimal substantive procedures. They place significant reliance on the controls, which allows for a substantial reduction in the extent of direct testing of the numbers.
Low control risk equals test controls plus minimal substantive work. That matrix makes it really clear. But notice, even in that last scenario, with strong controls and low control risk, it still says minimal substantive procedures, not zero.
That is a critical takeaway. You are absolutely right. Even with the strongest possible internal controls, auditors can never completely eliminate substantive procedures for significant account balances, transaction classes, or disclosures.
Why not, if the controls are great?
Several reasons. There's always the inherent limitation that controls can be circumvented by collusion or management override. There's also the risk of human error, even in good systems.
Yeah.
So professional standards require some level of direct substantive testing for all significant areas, regardless of the assessed level of control risk, as a final safety net. It provides fundamental direct evidence about the financial statements themselves. Hashtag 2.5, direct response to significant risks.
Okay, that baseline is crucial. Now, let's circle back to those significant risks, the really high priority ones identified based on inherent risk before considering controls.
Yeah.
Given their importance, are there specific mandatory actions auditors must take when responding to these, above and beyond the general net approach?
Yes, absolutely. Because these risks represent the areas of greatest potential vulnerability, auditing standards require specific heightened responses for all identified significant risks. These are non-negotiable actions.
Okay, what's the first one?
First, for any control that is intended to mitigate a significant risk, the auditor must evaluate the design of that control and determine if it has actually been implemented. They need to understand exactly how it's supposed to work and verify it's actually in place and functioning, not just documented somewhere.
Evaluate design, confirm implementation. Got it.
Second, and this is critical, if the auditor plans to rely on the operating effectiveness of internal controls meant to mitigate a significant risk, then tests of those controls must be performed in the current period.
In the current period, meaning they can't rely on tests from last year.
Correct. For controls mitigating significant risks, you cannot rely on tests performed in prior audits, even if the controls haven't apparently changed. The risk is considered too high and the potential for change or failure too great to rely on stale evidence. Fresh testing is required every year for these specific controls if reliance is planned.
Okay, current year testing for significant risk controls. What else?
Third, they must perform substantive procedures that are specifically linked and responsive to that significant risk. These aren't just general procedures. They need to directly target the potential misstatement arising from that risk. These procedures can consist of tests of details only, or sometimes a combination of tests of details and substantive analytical procedures, but they must be robust.
Direct, responsive, substantive tests.
Okay. Fourth, the auditor must obtain more persuasive evidence as their assessment of the significant risk increases. If the risk is judged to be very high on the spectrum, they need stronger, more convincing audit evidence. This might mean larger sample sizes, using more reliable types of evidence like external confirmations versus internal inquiry, or performing procedures closer to year-end.
More risk, stronger evidence needed. Makes sense.
Fifth, auditors are required to communicate all identified significant risks to those charged with governance. This typically means the company's board of directors, or more commonly, its audit committee. This ensures the people at the top, who have oversight responsibility, are fully aware of these critical financial reporting vulnerabilities and what management is doing about them.
Communication to the board committee. Important.
Very. Sixth, when it's applicable, like for audits of listed companies in many jurisdictions, the auditor must consider these significant risks when determining the key audit matters, or CAMs, to be included in the audit report.
CAMs, what are those briefly?
Key audit matters are those issues that, in the auditor's professional judgment, were of most significance in the audit of the current period's financial statements. They are selected from matters communicated to the audit committee, often including significant risks. Describing these CAMs in the audit report gives users more insight into the most challenging or complex parts of the audit.
Okay, transparency through CAMs. And the last one.
And finally, if the significant risk relates to a component in a group audit, say, a major subsidiary of a multinational corporation, the standards require more involvement by the group engagement partner. The lead partner needs to be sufficiently involved in understanding the risk at the component level and ensuring the audit procedures performed there are adequate, because a significant risk at a subsidiary could easily become material to the consolidated group financial statements. More oversight is needed.
All right, we've talked a lot about understanding controls, assessing control risk, and how that influences the overall strategy. But now let's dive deeper into the actual testing of controls. When does an auditor actually roll up their sleeves and test if these controls are truly working in practice? It seems like there's a clear difference between knowing a control exists on paper and proving it operates effectively day in, day out.
You've hit on an absolutely critical distinction there. Understanding a control's design, knowing its blueprint, what it's supposed to do is necessary, but it's definitely not sufficient to conclude that the control is actually operating effectively.
You need proof it works.
You need concrete evidence that it's actually doing what it's designed to do, doing it consistently, doing it correctly. Throughout the period, the auditor plans to rely on it. So tests of controls, tests of operating effectiveness are performed primarily in two main scenarios.
Scenario one.
Scenario one is when the auditor's risk assessment, remember that risk matrix, specifically the medium or low control risk assessments, is based on the assumption that controls are operating effectively. If you plan to rely on those controls to justify reducing your substantive testing,
You have to prove they actually work.
you absolutely have to test them to prove they work. You can't just assume the lock on the door is secure if you plan to rely on it. You have to jiggle the handle, check the key, maybe even try to pick it, metaphorically speaking.
Okay, rely on controls, test controls. What's scenario 2?
Scenario 2 is when, as we discussed earlier, substantive procedures alone are considered insufficient to provide enough appropriate audit evidence. This happens most often when an entity makes extensive use of IT, where transactions are initiated, processed, and recorded electronically with little or no visible paper trail, or when processes are highly automated.
The no paper trail situation again.
Exactly. If a company processes millions of online transactions entirely through an automated system without human intervention or physical documents being generated, the only way to get sufficient assurance about the completeness and accuracy of those transactions might be by testing the controls embedded within that IT system. Substantive testing of outputs might not be enough or even possible.
So heavy IT use often forces control testing.
It often does, and it's important to add, auditors only subject controls to tests of operating effectiveness if they've already determined that the controls are suitably designed to actually prevent or detect material misstatements in the first place. You wouldn't waste time testing the effectiveness of a control that was fundamentally flawed in its design. You'd address the design flaw first.
That makes a lot of sense. Design first, then test effectiveness. Now, can some of those initial procedures auditors do just to understand the controls, like walkthroughs? Can they sometimes serve a dual purpose? Can they accidentally provide some evidence about operating effectiveness too, even if that wasn't the main goal? Sort of an efficiency win.
Yes, that definitely can happen, and auditors are always looking for those efficiencies. Some of the risk assessment procedures, performed primarily to obtain an understanding of internal control, can provide some initial audit evidence about operating effectiveness, even if they weren't explicitly designed as tests of controls.
How so?
Well, take that walkthrough example. As the auditor traces a transaction through the system, inquiring, observing, and inspecting documents at each step to understand the design, they might simultaneously see evidence that the control was actually performed for that one transaction they traced.
So provides a little bit of effectiveness
A
evidence.
little bit, yes. Or consider IT controls. If IT processing is inherently consistent, meaning an automated control performs the exact same calculation or check reliably every single time, then testing whether that automated control has been implemented, meaning it's active and configured correctly in the system, might also provide some evidence of its operating effectiveness for automated functions, provided that the general IT controls over things like program changes and access security are also effective.
Because if the program hasn't changed, it should work consistently.
Exactly. Auditors can even intentionally choose to test operating effectiveness concurrently with obtaining their initial understanding of the internal control system, especially for less complex controls, to gain efficiency.
Okay. But there's a key distinction here, right? Another pass-key moment.
Yes, a very important one to distinguish the different stages and requirements. In a financial statement audit, the auditor is always required to obtain an understanding of the design of relevant controls and determine if they have been implemented. That's fundamental to assessing risk. They need to know how the controls should work and if they've actually been put in place.
That's the understanding phase.
Right. However, the auditor is not automatically required to evaluate the operating effectiveness of those controls as part of just obtaining that initial understanding. Testing operating effectiveness is a separate decision, driven by those two scenarios we just discussed: plan reliance or insufficient substantive evidence.
So understanding design and implementation is always required. Testing operating effectiveness is conditional.
Precisely. It highlights the clear difference between knowing the blueprint, design implementation, and actually testing the machine to see if it works consistently over time, operating effectiveness.
Okay, so when they do decide to test operating effectiveness, similar to substantive procedures, they need to determine the net nature, extent, and timing for these tests of controls. What specific evidence are they trying to gather here? What proves the control is really working?
When testing operating effectiveness, auditors need to obtain evidence that the controls selected for testing were both designed effectively, we covered that, and crucially, that they operated effectively throughout the entire period the auditor plans to rely on them. This involves gathering evidence about four key aspects of the control's performance.
Four aspects. First, whether the controls were applied at relevant times. Were they active and performing their function consistently when critical transactions occurred? Or were there gaps, periods where they were switched off, bypassed, or just not done? Okay, applied consistently over time.
Second, how the controls were applied. What was the specific process followed? Did the person performing the control do it correctly, according to the documented procedure?
Third,
Third, the consistency with which controls were applied. Was it done the same way every single time, or did the application vary depending on who performed it or the specific transaction? Inconsistency is often a red flag indicating the control isn't reliable.
Right. And fourth,
Fourth, by whom or by what means the controls were applied. Was it performed by the authorized person with the necessary skills and authority? Was it performed manually or by an automated system? Verifying the who or what is part of verifying effectiveness.
okay, so they need evidence on when, how, consistency, and by whom what. That's comprehensive.
It is. An auditor judgment is used to determine the specific nature, extent, and timing needed for these tests of controls to gather sufficient appropriate evidence on these four aspects for each control being tested.
Let's break down the net for control testing, starting with nature. What are the different types of procedures auditors use to test controls? You mentioned some earlier, but maybe rank them from those providing, say, less persuasive evidence to those providing more persuasive evidence.
Sure. There's definitely a hierarchy in terms of the persuasiveness of the evidence generated by different types of control tests. We generally use them in combination, but here's a rough order. Inquiry. This is simply asking the client's personnel about their duties and how they perform a specific control. For example, can you explain how you reconcile this bank account each month? Inquiry is important for understanding, but inquiry alone is never sufficient evidence of operating effectiveness. People might tell you the correct procedure, but that doesn't prove they actually follow it consistently or follow it correctly.
Okay, inquiry is a starting point, but not enough on its own.
Right. Next up is observation. This involves the auditor actually watching the control being performed in real time, like observing a warehouse employee performing cycle counts or watching a supervisor approve electronic timesheets.
Seeing it happen. That sounds better.
It provides more direct evidence than inquiry, but the limitation is that observation generally only provides evidence at the specific point in time the observation is made. People might act differently when they know the auditor is watching. So observation usually needs to be supplemented with other procedures like inquiry or inspection to get evidence covering the entire period of reliance. It's a snapshot, not a continuous movie.
Okay, observation is better, but limited in time. What's next?
Inspection. This involves examining documents, records, reports, or electronic files for evidence that a control has actually been performed. For instance, looking for a required signature or stamp on an invoice indicating approval, checking a log file for evidence of successful system backups, or reviewing completed bank reconciliation forms for the preparers and reviewers' initials.
Looking for the physical or digital footprint of the control.
Exactly. This provides tangible evidence that the control procedure was executed. It's generally more reliable than just inquiry or observation alone.
Okay, inspection is pretty solid. Is there anything more persuasive?
Yes, the most persuasive type of control test is often reperformance. This is where the auditor independently executes the control procedure themselves to verify its effectiveness.
They do it themselves.
Yes. If a control involves, say, comparing information on a sales invoice to the shipping document before billing, the auditor would take a sample of invoices and shipping documents and perform that comparison themselves. If a control requires recalculating depreciation expense, the auditor would recalculate it using the company's policy to see if they get the same result. Reperformance provides very strong evidence because the auditor is directly verifying the control's outcome.
Wow, okay. Reperformance is the gold standard then.
It often provides the most persuasive evidence of operating effectiveness, yes. But auditors almost always use a combination of these procedures, inquiry, observation, inspection, and reperformance, to build a sufficient and appropriate body of evidence about a control's effectiveness. The specific mix depends on the nature of the control itself. For example, for some controls, like segregation of duties where different people perform incompatible tasks, formal documentation might not exist. In that case, the auditor would rely much more heavily on inquiry of the relevant personnel and observation of their actual operations to see who is doing what.
Makes sense. Use the right tool for the job.
Exactly. And here's another related passkey: differentiating the procedures typically used for the two main control evaluation objectives. Procedures to test design effectiveness, is the control designed properly, generally include a mix of inquiry, observation, and inspection. Often, performing walkthroughs tracing that single transaction through the system while inquiring, observing, and inspecting at each control point is sufficient to evaluate design effectiveness. It helps confirm the control is logically placed and capable of working. Procedures to test operating effectiveness, does the control actually work consistently, are typically more rigorous. They usually involve a robust mix of inquiry of appropriate personnel, observation of the company's operations, inspection of relevant documentation showing performance, and critically, often include reperformance of the control by the auditor. This is where you prove the control does work, not just that it should work.
Okay, that covers the nature of control tests. Not for. How does an auditor decide how many instances of a control to test? If a control happens daily, do they test all 365 instances? Or just a few? How do you determine the sample size or scope?
That's a great question. No, they definitely don't test all 365 instances for a daily control that wouldn't be efficient. The general principle is that performing tests more extensively yields greater audit evidence and a higher level of assurance. But the auditor needs to determine the appropriate extent based on several factors.
Yes, sir.
First, the frequency of the control's performance during the period being audited. A control performed monthly will generally require fewer items to be tested than a control performed daily or multiple times a day to get the same level of comfort.
Okay, frequency matters.
Second, the length of time during the audit period that the auditor wishes to rely on the control. If they plan to rely on it for the entire year, they'll generally need to test more instances spread throughout the year compared to relying on it for only, say, the last quarter.
Period of reliance. Makes sense.
Third, the relevance and reliability of the audit evidence they expect to obtain from testing that control versus other potential evidence sources.
Yeah.
Fourth, the extent to which audit evidence about the same assertion is obtained from other tests, like other controls addressing the same risk or substantive tests. If multiple procedures provide evidence, the extent of testing for any single control might be reduced.
Synergy between tests.
Exactly. Fifth, critically, the degree to which the auditor wishes to rely on the operating effectiveness of a control in their assessment of risk, specifically to reduce the extent of related substantive procedures. The more the auditor wants to rely on a control to cut back on direct testing of the numbers, the more extensive their testing of that control needs to be. They need stronger evidence to justify that reliance.
Higher reliance or more control testing. Key relationship.
Absolutely fundamental. And finally, the expected rate of deviation from the control. This is the auditor's expectation of how often the control might fail or not be performed correctly based on prior experience or understanding. If they expect a higher failure rate, they'll generally need to test a larger sample size to confirm their expectation and determine if the actual deviation rate is still acceptably low for reliance.
Okay, so frequency, reliance period, other evidence, desired reliance level, and expected errors all factor in.
Correct. And a few other practical considerations for extent. If a control is applied on a transaction basis throughout the period, like approvals for every purchase order, auditors typically use statistical or non-statistical sampling techniques to select the specific instances to test. The sample size is determined based on factors like tolerable deviation rate and desired confidence level. Remember how we said IT processing is inherently consistent? For automated application controls, like a system automatically checking customer credit limits, testing just a few instances might be sufficient to conclude it works initially, because if the program logic works once, it should work every time, unless the program changes.
The unless it changes part is key.
It is. So while initial testing might be limited, the auditor also needs evidence that the automated control continued to function effectively throughout the entire period. This often involves testing the related general IT controls, particularly those over program changes, access to programs, and computer operations, to ensure the automated control wasn't tampered with or didn't fail due to system issues.
So testing the controls around the automated control.
Precisely. Sometimes testing indirect controls, like those general IT controls or controls that monitor the performance of other controls, is necessary because they support the effective operation of the direct application controls the auditor wants to rely on.
Okay, nature and extent covered. Let's talk timing for control tests. Does it matter when during the audit period a control is tested? Can they just test everything at year end, or is interim testing common here too?
Timing is definitely strategic for control testing as well, and it impacts the evidence obtained. There are two main aspects to consider: testing at a particular time versus throughout a period, and using evidence from prior audits.
Okay, let's start with testing at a particular time versus throughout a period. What's the difference?
A control that is tested only at one specific point in time, for example, the auditor observes the client's physical inventory counting procedures only on December 31st, provides evidence about operating effectiveness only at that moment.
A snapshot again.
Exactly. However, for controls that operate continuously throughout the year, like daily sales order approvals. The auditor needs evidence that the control operated effectively throughout the entire period they plan to rely on it. Testing controls throughout the period provides that evidence. This might involve testing samples drawn from different points in time during the year.
Can they test controls at an interim date before year end?
Yes, auditors often test controls at an interim date for efficiency reasons. However, if they test controls at an interim date, say September 30th for a December 31st year end, and intend to rely on them for the full year, they must obtain additional audit evidence for the remaining period, October 1st to December 31st.
How do they cover that remaining period?
They might perform some additional tests of the control covering the remaining period, or they might combine the interim control testing results with evidence obtained from substantive procedures performed during the remaining period, or inquiry and observation. They need to bridge that gap. For controls related to significant risks, though, remember, they generally must be tested covering the period up to year end if reliance is intended. Also, certain controls only operate at period end, like controls over the financial statement closing process. So those would naturally be tested at that time.
Okay, so timing depends on the control and the reliance period. What about using evidence from last year's audit? Can they do that to save time?
This is a key area for potential efficiency, but it comes with very strict rules and significant judgment. Yes, evidence about the operating effectiveness of controls obtained in a prior audit, say last year, can potentially be used in the current year's audit, but only if several conditions are met.
What are the conditions?
First, the auditor must obtain audit evidence in the current period about whether any significant changes in those specific controls have occurred since the prior audit. They need to confirm the control hasn't been modified or replaced.
Okay, check for changes. What if controls have changed?
If the controls have changed significantly, then their operating effectiveness must be retested in the current period. You absolutely cannot rely on prior audit evidence for controls that are different now. It's essentially a new control.
Makes sense. What if the controls haven't changed? Can they rely on last year's tests then?
Even if the auditor determines that the controls have not changed significantly, auditing standards require that the operating effectiveness of those controls must be tested at least once every third year.
Once every 3 years minimum, even if no changes.
Yes. This ensures that reliance isn't based on perpetually outdated evidence. The standards also caution auditors to vary the testing over the 3-year cycle. Don't test all controls eligible for rotation in year 1 and then none in years 2 and 3. Spread it out.
Okay, a 3-year refresh cycle, minimum.
Minimum. Auditors may choose to retest controls more frequently than every 3 years, and often do. Factors that might lead them to retest sooner include a higher assessed risk of material misstatement for the related assertion, a plan to place greater reliance on the control to reduce substantive testing, indications of a weak overall control environment, or if the control has a significant manual component, as manual controls are inherently less consistent than automated ones.
And is there anything they can't rely on prior evidence for?
Yes. Absolutely. Critical exception. Auditors may not rely on audit evidence obtained in prior audits for controls that mitigate a significant risk. Remember those high priority risks. For controls related to those, the operating effectiveness must be tested every single year if reliance is planned. The risk is too high to use old evidence.
Got it. Significant risks, annual control testing. No exceptions for prior evidence. Okay, so the auditors have gone through the net nature, extent, timing for their control tests. They've done their inquiries, observations, inspections, reperformances. What happens next? What conclusions can they draw based on the results of all these tests? And crucially, what if they find problems? What if the controls aren't working as expected?
The audit evidence gathered from these tests of controls will lead the auditor to one of two fundamental conclusions about the operating effectiveness of the controls they tested, and this conclusion then dictates the next steps in their audit strategy.
Conclusion number 1.
Conclusion number 1 is the good outcome. Controls are operating effectively and can be relied upon as planned in the initial risk assessment. If this is the case, the auditor can proceed to design the nature, timing, and extent of their substantive procedures based on that lower assessed level of control risk. This generally allows for a more efficient audit, potentially with less extensive direct testing of the numbers because they have confidence in the client's internal systems.
Okay, controls work, proceed as planned. Likely reduce substantive testing. What's conclusion number 2?
Conclusion number 2 is the problematic one. Controls are not operating effectively as anticipated. The tests revealed deviations, inconsistencies, or failures.
So the controls failed the test. What does the auditor do then?
In this situation, the auditor has a couple of immediate options, and the original audit plan needs to change. First, they could potentially test alternative controls. Maybe the primary control they tested failed, but they become aware of a different compensating control that addresses the same risk. They could decide to test that alternative control to see if it's effective. More commonly, though, if the plan controls are found to be ineffective, the auditor must reassess control risk for that assertion. This typically means increasing the assessed level of control risk, reassessing it from the planned low up to medium or even high.
And increasing control risk means?
Yeah. Increasing the assessed control risk directly increases the need for more reliable and extensive substantive procedures. If the internal safeguards aren't working, the auditor has to compensate by doing more work themselves, digging much deeper into the actual account balances and transactions to get sufficient evidence that they are free from material misstatement. The planned efficiency gain is lost.
Okay, so control failure leads to more substantive work. Can we talk about common types of control failures or deficiencies auditors find?
Definitely. We often categorize common control deficiencies into two broad types: problems in the design itself, or failures in the operation of controls that were otherwise adequately designed.
Let's start with deficiencies in the design of controls. What are some examples?
These are issues where the control, as conceived or documented, just isn't capable of preventing or detecting misstatements. Examples include inadequate documentation or just a poor design of internal control over a key area, like the preparation of the financial statements themselves, or over a significant account like revenue or inventory. A clear lack of appropriate controls ensuring segregation of duties. For instance, if the same person can approve payments, record them in the system, and also reconcile the bank account, that's a design flaw creating opportunity for error or fraud. Inadequate design of critical IT controls like poor password policies, lack of controls over who can change programs, or insufficient backup and recovery procedures. A lack of qualified or trained client personnel in key financial reporting or control rules. The system might rely on someone who simply doesn't have the skills to perform the control effectively. An inadequate design of monitoring controls, how management oversees the control system itself, or the absence of a proper process for identifying and reporting control deficiencies internally. These are fundamental flaws in how the control system is set up or overseen.
Okay, those are design flaws. What about failures in effectively designed controls? The control looked good on paper, but didn't work in practice.
Right. Here, the blueprint might have been okay, but the execution failed. Examples include the actual failure of a specific control procedure over a significant account or process, like finding purchase orders that lack the required authorization signature, or bank accounts that weren't reconciled for several months, or assets like inventory or equipment that weren't properly safeguarded against theft or damage. Evidence of undue bias or a lack of objectivity by the person performing the control. Maybe a manager who always approves their own team's expense reports without any real scrutiny. This is a big one. Misrepresentation by client personnel to the auditor. If the auditor discovers client staff lied or deliberately provided misleading information about how a control operates, that's a major red flag, indicating a breakdown in integrity and potentially fraud. This is a big one. Evidence of management override of controls. This is where management intentionally bypasses controls that they themselves likely put in place, often to perpetrate fraud or manipulate results. Very serious. This is a big one. An observed deviation rate in the auditor's sample testing that significantly exceeds the auditor's expectation. If they expected maybe 1% of controls to fail but find 10% failed in their sample, that indicates the control is not operating effectively. This is a big one. A failure of the information and communication component of internal control, meaning the system isn't providing complete, accurate, and timely information to the right people to allow them to perform their control duties effectively.
Okay, so if these deficiencies, either in design or operation, are noted, it's clearly not good news. What happens next strategically? Does the audit just stop?
No, the audit doesn't stop, but the strategy definitely pivots, and more work is required. If deficiencies are noted, the auditor must.
First,
Consider if there are any compensating controls. As mentioned, these are other controls that might mitigate the risk arising from the identified deficiency. For example, if segregation of duties over cash receipts is weak in a small company, perhaps a very detailed and independent review of cash reconciliations and bank statements by the owner acts as a compensating control that lessens the risk of undetected misappropriation.
okay, look for backups.
Then they must evaluate the severity of the deficiency. They need to decide whether it constitutes a significant deficiency or rises to the level of a material weakness.
What's the difference again? Material weakness sounds worse.
It is worse. A significant deficiency is defined as a deficiency or a combination of deficiencies. In internal control that is less severe than a material weakness, yet important enough to merit attention by those charged with governance, the board or audit committee. A material weakness is more serious. It's a deficiency or combination of deficiencies such that there is a reasonable possibility that a material misstatement of the company's annual or interim financial statements will not be prevented or detected and corrected on a timely basis. It's a higher threshold of severity. Identifying a material weakness has significant reporting implications, especially for public companies.
Okay, assess severity, significant deficiency, or material weakness. What else?
They need to consider the potential magnitude of misstatements that could occur because of the deficiency and the likelihood or possibility that such misstatements could occur and not be detected. This helps judge the severity.
Right, magnitude and likelihood again.
And finally, and most importantly from a procedural standpoint, they must design specific substantive tests that directly address the potential misstatements related to the identified deficiency. If a control designed to ensure all sales are recorded properly was found to be ineffective, the auditor now has to perform more extensive substantive procedures, maybe detailed analytical reviews of revenue trends, testing sales cutoff more rigorously, or reconciling shipping logs to invoices to gain assurance that revenue isn't materially understated due to that control failure. They have to directly address the gap left by the failing control.
All right. We've navigated the intricate world of identifying risks and testing internal controls, but we've established that even with great controls, auditors still need to do direct testing. And certainly, if controls are weak or untested, this next part is crucial. So let's talk about that ultimate safety net, substantive procedures. What exactly are they, and how do they provide that final layer of assurance?
You framed it perfectly. Substantive procedures are the bedrock of obtaining direct evidence about the numbers and disclosures in the financial statements. They are audit procedures specifically designed to detect material misstatements at the relevant assertion level: existence, completeness, valuation, etc.
So finding the actual errors.
Exactly. Finding material errors or misstatements, whether caused by error or fraud. Their nature, extent, and timing, net, are always designed to be responsive to the assessed risks of material misstatement for each assertion. This assessment includes considering the results of any tests of controls that were performed and also the auditor's desired level of detection risk.
Detection risk. Remind me what that is.
Detection risk is the risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will fail to detect a misstatement that exists, and that could be material, either individually or when aggregated with other misstatements. Substantive procedures are the primary tool auditors use to reduce detection risk.
Okay, so substantive tests lower the risk of missing something important.
Precisely. And here's that fundamental point we touched on earlier, but it's so important it bears repeating. Regardless of the assessed level of control risk, even if controls are deemed highly effective, and control risk is assessed as low, substantive procedures are required for each relevant assertion of each material transaction class, account balance, and disclosure.
Cannot skip them entirely for important stuff.
Cannot skip them entirely, period. There's always a baseline level needed due to inherent limitations of controls, like management override or collusion. Also, an interesting nuance: just because a substantive procedure doesn't find a material misstatement, it doesn't automatically prove that the related internal control was operating effectively. They provide different types of evidence and answer different questions. One checks the process, control test. The other checks the outcome, substantive test.
That's a key distinction. So what are some of the absolute fundamental things that substantive procedures must include in every audit as a baseline?
There are a few non-negotiable core procedures that are always part of substantive tests. First, they must include procedures to agree the financial statements, including all the notes and disclosures back to the underlying accounting records. This means tracing the numbers from the face of the balance sheet or income statement back to the trial balance, then to the general ledger, maybe even to subsidiary ledgers or schedules, verifying everything ties together mathematically and agrees.
Tying the final report back to the source data.
Exactly. Foundational reconciliation. Second, they must include an examination of material journal entries and other adjustments made during the course of preparing the financial statements.
Why focus on journal entries?
Because journal entries, especially non-standard or manual ones made late in the reporting process, are often used to manipulate financial results or conceal errors or fraud. Auditors will scrutinize these material entries for unusual characteristics, lack of support, odd timing, or suspicious descriptions.
Okay, scrutinize material journal entries. What else is mandatory?
And third, they must include procedures to evaluate the overall presentation of the financial statements, including the adequacy and completeness of the disclosures, to ensure they are in accordance with the applicable financial reporting framework, like GAAP or IFRS.
So not just checking numbers, but how the whole story is presented.
Precisely. Does the presentation make sense? Are things classified correctly? For example, current versus non-current assets liabilities? Are all the required disclosures included? Is the information presented clearly and understandably? Is the structure appropriate? It's about ensuring the financial statements as a whole, including the critical footnotes, tell the right story fairly and completely according to the rules.
Okay, those are the mandatory inclusions. Now, within the broader category of substantive procedures, what are the main types of procedures auditors use to directly check those numbers and disclosures?
There are primarily two main types of substantive procedures auditors employ.
Type 1.
Type 1 is tests of details. These are, as the name suggests, granular audit procedures used to gather direct evidence supporting the specific account balances, individual transactions, and disclosures presented in the financial statements. They involve looking at the underlying details that make up those balances.
Can you give some examples of tests of details?
Sure. For testing the existence and valuation of accounts receivable, a common test of details is sending confirmations directly to a sample of customers asking them to verify the amount they owe. For inventory, tests of details would include physically observing the client's year-end inventory count, performing test counts themselves, and testing the pricing and valuation of selected inventory items by comparing costs to invoices or market values. For cash, it's confirming balances directly with banks. For property, plant, and equipment, it could be physically inspecting major assets additions during the year. These are the specific, item-by-item, often labor-intensive checks verifying the details. They can be performed on the ending balances directly or on the details of the individual transactions that occurred during the period that affected those balances, or often a combination.
Okay, tests of details, getting into the weeds, verifying specific items. What's the second main type?
The second main type is substantive analytical procedures. These are quite different. They involve evaluations of financial information made by studying plausible relationships among both financial and non-financial data.
Plausible relationships, like trends, comparisons.
Exactly. It generally involves the auditor developing an independent expectation of what an account balance or ratio should be based on their understanding of the client, the industry, and relationships between accounts, and then comparing that expectation to the actual recorded amount reported by the client.
And if there's a big difference.
If there's a significant difference between the auditor's expectation and the client's number, it indicates a potential misstatement that requires further investigation, usually through performing tests of details on that specific area.
Can you give an example of an analytical procedure?
Sure. A classic one is analyzing gross profit margins. The auditor might expect the company's gross margin percentage to be relatively stable compared to last year, or consistent with industry averages, unless they know of specific reasons for a change, like new pricing or cost changes. If the recorded gross margin suddenly jumps unexpectedly, the auditor would develop an expectation, compare it, identify the large difference, and then investigate why. Did sales prices increase? Did costs decrease? Or is there potentially an error in recording sales or cost of goods sold? Another example might be comparing payroll expense to the average number of employees. You'd expect a plausible relationship there.
Okay. So it's about looking for things that don't make sense from a high level based on predictable patterns.
Precisely. Spotting anomalies or deviations from expected trends or relationships.
So do auditors have to do both types, tests of details and analytical procedures?
Not necessarily both for every single assertion. Auditors can choose to use only substantive analytical procedures for some assertions, only tests of details for others, or often a combination of both, depending on their judgment about what will be most effective and efficient in the circumstances given the assessed risks.
When might they choose one over the other?
Substantive analytical procedures are often particularly effective and efficient for auditing large volumes of transactions that tend to be predictable over time. Think about routine expenses like rent or utilities, or maybe revenue streams that are very stable and predictable based on non-financial data, like production volumes or subscription numbers.
Okay, predictable stuff suits analytics. When are tests of details better?
Tests of details are generally considered more appropriate and often necessary for obtaining sufficient evidence regarding certain assertions, particularly existence and valuation of account balances. For example, analytical procedures alone usually can't prove that inventory recorded on the books actually physically exists or that a specific piece of equipment is correctly valued. You often need the direct verification provided by tests of details like observation or confirmations for those.
Right. Hard to analyze existence.
Exactly. The choice also depends on the results of control testing. If tests of controls indicate that the client's controls over a particular process are effective, then substantive analytical procedures may be sufficient on their own to reduce detection risk to an acceptable level for some assertions, because the auditor has more confidence in the underlying data being reliable.
Good controls might allow more reliance on analytics.
Potentially, yes. Conversely, if tests of controls show that controls are not effective, or if tests of controls were not performed at all, like in a substantive-only approach, the auditor may need to perform tests of details only, or at least rely much more heavily on tests of details. They can't rely as much on the insights from analytical procedures if the underlying data generated by the flawed control system might be unreliable itself.
Okay, we have the two main types or natures. Now let's talk extent for substantive procedures. How does the auditor decide the scope? How much digging is enough digging when they're directly testing the numbers? Is it just bigger samples again?
The core principle is the same as with controls. The more extensively a substantive procedure is performed, the greater the evidence obtained, and thus the higher the level of assurance. The specific extent is directly affected by that interplay between risk assessment and the need for evidence.
How does risk play in?
The overall risks of material misstatement, inherent risk and control risk combined, are key drivers. The higher these assessed risks are for an assertion, the less detection risk the auditor can accept. To achieve that lower acceptable detection risk, they need to gather more persuasive evidence, which generally translates directly into a greater extent of substantive procedures.
Higher risk, less room for error, more testing.
Exactly. If there's a higher chance of something being materially wrong, you simply have to look harder and more widely.
And what about the impact of control risk specifically?
Control risk has the inverse effect, assuming controls were tested and found effective. If controls are operating effectively, meaning control risk is assessed as low, the auditor can generally accept a slightly higher detection risk, and therefore the extent of substantive procedures may potentially be reduced. This is where the efficiency gain from relying on good controls really materializes less need for extensive, direct testing of the details.
So good controls can mean smaller sample sizes for substantive tests.
Potentially, yes. For tests of details, extent does generally refer specifically to the sample size. So a higher assessed risk of material misstatement, either due to high inherent risk or high control risk, will almost certainly lead to the auditor selecting a larger sample of items to examine. It's a direct, logical relationship aimed at achieving the desired overall level of audit assurance.
And finally, timing for substantive procedures. We touched on this earlier, but can these direct tests of numbers be done at any time? Can auditors do most of this work months before year-end, or is performing them right at year-end generally preferred?
Substantive procedures offer flexibility in timing. They can be performed during an interim period, before year-end, at period end, or even sometimes after period end, like reviewing subsequent cash collections. However, the timing decision has significant implications for audit risk and the amount of work needed.
What are the pros and cons of interim testing for substantive procedures?
Performing substantive procedures at an interim date, say, confirming accounts receivable balances as of October 31st for a December 31st year-end, can have advantages. It can help identify significant issues earlier in the audit process, allowing more time for resolution. It can also help spread the audit workload more evenly.
Sounds good. What's the downside?
The major downside is risk. If substantive procedures are performed at an interim date, the auditor then needs to perform further procedures to cover the remaining period, from the interim date to year-end, to extend their conclusions to the actual period end. This might involve further substantive procedures focusing on the activity in the roll-forward period, or perhaps combining the interim results with tests of controls covering that remaining period. Performing substantive procedures at an interim date inherently increases the risk that the auditor might not detect material misstatements that arise after the interim testing date but before year-end. And that risk generally grows the longer the remaining period is.
The bigger the gap, the more that could go wrong undetected.
Precisely. Which is why, for situations with identified fraud risks or particularly high risks of material misstatement for an assertion, auditors often consciously choose to perform the related substantive procedures at or near the period end. This minimizes that detection risk for the most critical areas by providing the most current evidence right when the books are being closed.
Okay, so high risk often pushes substantive testing closer to year end.
Generally, yes. Now, if substantive analytical procedures are used to help extend conclusions from interim substantive testing to period end, the auditor needs to carefully consider a few things. Are the period end balances reasonably predictable based on the interim results and trends? Are the entity's accounting procedures applied consistently? And is the information system reliable enough to provide data needed to investigate any unusual transactions or significant fluctuations that arise in that final stretch between the interim date and year end?
So extending conclusions isn't automatic.
Definitely not. And if misstatements are discovered during substantive testing at an interim date, that's a red flag. The auditor must modify their related risk assessment and likely increase the nature or extent of the audit procedures planned for the remaining period. They might even decide they need to repeat certain substantive procedures right at period end to get a fresh, comprehensive look, because the interim findings suggest the problems might be more pervasive or persistent.
Okay. And one last point on timing. Can auditors rely on substantive evidence from prior audits, like they sometimes can with controls?
Generally, no. Evidence obtained from substantive tests performed in a prior audit usually provides little or no evidence for the current period. Financial position and performance change year to year. Balances fluctuate, transactions occur, risks evolve. Auditors need fresh, current substantive evidence each year to support their opinion on the current period's financial statements. While prior year results can inform expectations for analytical procedures, the direct substantive evidence itself needs to be current. Hashtag tag outro rec.
Wow. Okay. We have really taken a deep dive today, haven't we, into this incredibly methodical, really multi-layered process that auditors use. Identifying risks, assessing them at different levels, figuring out the right response through control tests and substantive procedures. It's truly a complex dance, isn't it? Between that high-level strategy and the incredibly granular detail.
It really is. It's a constant weighing of likelihood and magnitude, inherent vulnerabilities versus control strengths.
It makes you appreciate the sheer volume of professional judgment involved. It's definitely not just black and white numbers. It's navigating so many gray areas, making critical judgment calls at every step.
Absolutely. And if there's one key takeaway from all this detail, it's that auditing isn't just about, crunching numbers or ticking boxes on a checklist. It's a systematic, disciplined process. It requires thinking like a detective, understanding all the potential pitfalls and vulnerabilities in a business and its environment.
Right, the detective work.
Then strategically gathering the right kind of evidence, using that mix of control testing and direct substantive procedures we talked about, and ultimately ensuring the reliability of the financial information presented. This rigorous, often unseen process is truly the backbone of trust in our entire financial system.
It really is what allows everything else to function, isn't it?
It's fundamental. It's what allows investors to make informed decisions with some level of confidence, what allows banks to lend money, what allows businesses to trade with each other, all based on the premise that the financial information they're using is credible.
And connecting that back to you, our listener, why does all this intricate audit methodology matter to you? Well, because the trustworthiness of that financial information is absolutely fundamental, whether you're investing your savings, trying to run a business effectively, evaluating a job offer, or even just trying to understand the broader economic landscape we all live in.
That clean, audited financial report you might glance at, it's the culmination of this incredibly diligent, demanding process we've just walked through.
It really is a testament to an almost invisible army working behind the scenes to provide that crucial assurance. So here's a final thought to leave you with. Next time you look at a company's annual report, maybe pause for a second and consider that invisible army of auditors. Think about how they've delved into every potential risk, from those big-picture control environment issues down to the details of the smallest significant transaction, all just to give you that reasonable assurance. And then maybe ask yourself, what might the societal impact be if this rigorous process didn't exist? Or if it were somehow systematically circumvented?
Imagine a world where every financial statement was just a wild guess. Or worse, deliberate fiction. It's a powerful thought.
It really is. Something to definitely chew on. Thank you so much for joining us on this deep dive today. Keep learning, keep questioning those numbers, and we'll see you next time.
Thanks, everyone.